Well, hello everybody. Welcome to Friday, another Go Live with Tom show today. Really excited about this. We've been having a great time with this. We have a pretty simple format. You can send in your questions to Ask Tom at golivewithtom.com. And then Katie, who at the bottom of the screen is going to be our moderator. And she will be, receiving your questions and she'll ask the questions. And then Eason is another one of our advisors here at Retirement Capital Strategies. You can ask him questions directly also, but he'll also come up with some follow-up questions so we can kind of dig into the different areas that you come up with. So really looking forward to this. And again, our big component here is trying to build out investor education for our clients. And really, we believe that wealth and net worth are built through knowledge. Obviously the knowledge of your advisors, but the more that the farther that you can go, and really maybe the safer that you can be with your money also. So really, really look forward to this. Again, we are going to be posting these educational videos on our YouTube channel, which is what you're looking at right now. And if you're interested in finding out about those, you want to hit the subscribe button that's right there. And if you want to get an email notification, you hit the little bell button, and we can kind of, be able to see what's being posted on there. So look forward to that. So let's start off with the first question. What do you have, Katie?
So the first question we have is the stock market going to crash this year?
Okay, that's a good question, actually. It came in earlier this week. We've had a lot of volatility in this month, and markets down maybe 5% from its high, in May here. So, people start to wonder about what's going to be happening. And of course, if you look at the popular press, there's almost always, almost every day, there's somebody writing an article about the stock market crash that's coming. Uh, those are very popular articles. They get a lot of, views, which is why people keep putting them out. There's a negative bias that seems to work quite well, unfortunately. In my daily video updates that I do every day, I do try to highlight some of the positive things that are happening just to kind of offset some of the negatives. So, that's kind of important too. So we'll focus on a few things, but let me show you kind of my thoughts on what we're seeing, with the market, and why I think this year could be safe from a big downturn as far as that goes. But first, let's just define what a downturn is. I mean, when you say crash, so let me share my screen here. Okay, so this is a chart here of the last 25 years for the S&P 500. And you can see, we had this big downturn here in 2000, a little over 40% drop for the S&P 500. And then, of course, the 2008 downturn that we're all familiar with, over 50% drop for the S&P 500. We had a little one here in 2018, almost 20%, didn't last long. And then, of course, we have the big pandemic drop here, which was 35%. That's the fastest 35% down market in history. And you can see actually we recovered from that quite quickly also. So the first thing to talk about is just what is a crash. So I would say a crash is something in that 25% or higher range. And anything less than that is pretty common. You can see how many little downturns we had here and here and here. And, even like I said, right now we're down 5% from the high, that we were at earlier this month. So, kind of that 5, 10, 15%, that can happen. And I expect that to happen. And so you really want to have your portfolio placed in the right risk level so you can handle those types of fluctuations, because those are pretty common. That's what happens all the time. So, what we'll just focus on the word crash, and I'll call that a 25% or higher, event like this. And so, what would be, the criteria that would kind of precipitate that type of downturn? And one of the things that I tell myself all the time, just from my own studies, is that a big crash in the stock market has two components. Number one, obviously the stock market going down, but number two is the economy going down, especially the leading indicators. So let me see, I opened up the leading indicators piece here. Let me find it real quickly. Yeah, so this is a thing called the Conference Board, which is a group that does some of the reporting on all kinds of different indicators. And this is a basket called the LEI, stands for Leading Economic Indicator. And there's 10 pieces in here, including the S&P 500, but it's, manufacturing demand, initial unemployment claims, and these are indicators that they've chosen that they feel lead the economy. And so this goes all the way back to the 1960s, which is kind of incredible. And you can see, all these little gray spots were recessions. And so you can see that this leading indicator, peaked out oftentimes just before these gray lines. Pretty good predictor of an upcoming recession. So when the leading economic indicator starts to go down and the stock market starts to go down, that is a sign that we could be in for something that might be in that kind of 25% or higher downturn. So if you see here, here was the just before the 2000 downturn, it peaked out. And this was back in 2006. It peaked out again before the 2008 downturn. So these are things that I'm looking at. Now, one thing that's kind of fascinating here is this. So we had this big drop for that shutdown, for last year's shutdown. And then look at how fast things have come back. And this is really important to understand. So, number one, this downturn that we just had for the pandemic, the leading indicators were still going up. So it didn't help us to know because it was not an economic event. It was a health event that created an economic event. So, assuming we don't have another one of those anytime soon, which I'd be very surprised to see another full shutdown, even if the variants kind of jumped out a little bit. Um, I think that is the only situation where I've seen where the economy and the stock market together don't go together. So so look at where it's doing right now. So they just reported it was up 1.6% higher than last month, which is a giant jump for this indicator. It's up 17% more than last year, which is a tremendous jump for a 1 year period. Anytime you had the leading indicators jump by 7% or more historically, I think 82% of the time that happened, you ended up with the S&P 500 at 6%, sorry, 8% higher than it was prior to that. So if you look at this really closely, how many times have you seen big drops where the leading indicators are going down? I haven't seen any, except for, sorry, they're going up. The only time I've seen it go up and the market go down was during the pandemic. So, barring a pandemic, these indicators are going up tremendously. So, really, really amazing time right now. So, are we going to have a crash this year? It would be one of the most unusual crashes in history as far as that goes, because the indicators here are going up so strongly. And the other thing, and generally what ends up slowing down the economy is the federal funds rate. So the Fed sets rates and they basically come in and they say, okay, here's the current rate. And so you can see prior to the 2000 downturn, it went from about 4.75 all the way up to 6.5. And we ended up with the 2000 downturn. And then we went from 1%, roughly all the way up to 5.25. And we had the 2008 downturn. And then we had this big upturn. This actually led to some of the downturn that happened at the end of 2018, that little 20% one we looked at. But now we're at zero. So again, going back through time, when you see rates at zero, it's very difficult for the market to fall apart. The big component that's happening right now is just the fact that people are feeling like they're going to have to raise rates sooner than they said they would. So, yeah, that's the issue that's happening in terms of inflation and those types of things. So, again, looking at kind of what's happening here, I have a hard time imagining a big giant downturn. However, I'll show you one piece here. Let me sign in real quickly. This is sort of a fascinating area to look at inside the market, because there are some pieces where the market is actually having some trouble here. And let me get this. There we go. So this is what's called the 9 boxes. And so this is today, right now, as it's live. And you can see here the value stocks are doing better today, right? And some of the large growth has slowed down a bit today. And so these, pieces are really important. But if you go back for the 3 months, you can see actually there has been a pretty significant market downturn on this growth side, especially this kind of smaller growth piece. So I will say that there is something a little different about this particular market that you have to be careful with, and that's just that you could have a quasi crash for a piece of the market. This is the portion here, this column that did so well last year that is struggling so far this year. So that aspect of it, I think, is kind of important to understand. You probably want to be leaning more towards the value side of the equation because as interest rates come up and as the economy reopens, these stocks theoretically have a better chance of avoiding some of the downturns if it does happen than you might see in some of these growth stocks here as far as that goes. So anyway, so that's the answer to that. Do you have any feedback on that, Ethan, or other questions?
So you talked about indicators. Can you kind of give a basic understanding of what's like a leading versus like a lagging indicator?
Yeah, they have like three different levels. Matter of fact, you can kind of see this is the leading one, and then this is the coincident one. So coincident indicator would be something that kind of moves about the same as the economy, and you can kind of see that here. See where this peaked right at the time when the economy started into recession, for example. And then the lagging indicator. So you see this one peaks in the middle of the actual recession itself. And so your your leading indicators are going to be things like new orders for manufacturing and initial jobless claims as far as that goes. And this is going to be, you'll see a lot of consumer confidence numbers inside of coincidence. So they tend to have, it's not really a leading indicator, but it's not a lagging indicator either. And the most common lagging indicator that people would understand is actually the unemployment rate. So when the unemployment rate peaks, it's often, it's not an indicator of continued problems with the economy because it's often happening, kind of in the middle of those recessions. So that's what that is. And I've just found that and this is the one I focus on the most and know the most about, but I've just found that this particular index, which gets reported every month, is really important to follow. Again, every time I see, like right now, 5% down, but the indicators are up, that's usually a buy signal. Because that means that the market is not, is just taking a rest in the middle of a economic, boom, really, is what's happening here, the way that this line's going. And so anyway, that's why I like this a lot. It just, if I see this coming down and the market coming down, if you're down 5% and the leading indicators were dropping, I would be nervous about having a bigger downturn, definitely. Anything else? So we go to the next one?
Great. Thank you for that amazing visual again, Tom.
Sure.
So we have a question in from Carol saying, I have a lot of cash to invest and am unsure of if I should invest it all at once. Do you have a strategy for doing partial investment periodically?
Yeah, I think what you're talking about there is what we call dollar cost averaging. So there's two processes there. One would be kind of the thought process of lump sum, and the other. And actually, let me share my screen again. I can kind of show it to you here just on this chart. So if you look, here's the S&P 500. So if we happen to be right here, for example, if we go back in time and you lump sum the money in, well, it drops quite a bit, right? Before you get to, a point where, eventually it comes back. And so you can make an argument for dollar cost averaging where say every month, each one of these little bars is a month, you'd put money in. And that actually works very, very well for kind of protecting yourself from, these particular downturns. The problem with doing a pure dollar cost average versus a lump sum is just that if you look at this chart, it spends most of its time going up. And so what that means, and if you look month by month, if you were to look at each one of these months and look at how many times it was going down versus how much it goes up, the market goes up more than down, at least in this 25-year period. And I would assume, that might be true going forward also. So when you dollar cost average, you could be, you'd be better off if you had a lump sum right here, just putting it in, correct? Instead of dollar cost averaging all the way up here, because you would have been better off investing all of it up front. So generally speaking, unless there's something pretty substantially strange about the situation, we actually do lump sums, although we'll do it in a kind of measured manner. So I have 15 pieces on the stock side and 5 pieces on the bond side in my portfolios. And I generally have a buy or a hold on all of those at any point in time. So when new money comes in, we just wait until that one section that we're going to buy is doing okay. And so we'll buy those and we'll wait for the other ones. And so we kind of use, I guess we'll call it a more intelligent dollar cost averaging methodology to come into the market. And that way, if the whole thing is falling apart, we sit in cash, which is exactly what happened last year. Had money coming in middle of February, beginning of March, market is falling apart. We didn't buy anything until April. We just held on to that cash. And so I think that's kind of, a measured way of doing dollar cost averaging. Um, Generally speaking, dollar cost averaging is done in a more appropriate manner by money that you don't have, so or that you're going to have in the future. So if I have 50,000 now, I'm going to put that in the market. I'm going to buy what I have on my buy list and wait for the other things to turn into buys. And then if I have an extra $100 a month, that's what I'm going to dollar cost average with going forward. So that's how I look at it. Again, you just have to look at the probabilities. The probability is that the market is going to go up from where we are, and doesn't mean it's 100% probability, but that's the bet. So I'd probably do a lump sum in a buy hold fashion where I would buy what I wanted to buy piece by piece, and then I would dollar cost average with future money that's coming in.
Thank you. We have another question in from Sam saying, do I need to take money out from my IRA and I'm not retired yet? Is there an ideal age for making such a withdrawal?
Well, if you're not retired yet from an IRA, and you're prior to 59 and a half, there is a penalty for withdrawal prior to that point. So obviously, if you're not retired and past 59 and a half, that's going to be a more ideal age, just in the sense that you don't have that penalty. There are two ways around that penalty prior to 59 and a half, at least that are very common. Number one is you are allowed to take money out of an IRA for 60 days. So if you just have a short-term need and you know you're going to get the money back, you could take the money out of the IRA and put it back within the 60-day window. And that would allow you to not pay taxes or penalties on that withdrawal. So, I ended up doing that when I was buying my home, for example, or building my home. And so, I needed some money for something and I had something coming in, et cetera. So that can be effective for certain situations. The other way is what's called a 72T. It's a tax law, and it allows you to take money out prior to 59 and a half. But there's this a big calculation that happens to figure out how much you can take out. You have to take it out for at least 5 years or 59 and a half, whichever is longer. And so anyway, that's more for an early retirement situation. So somebody's retiring before 59 and a half will use 72T to kind of create some income if they don't have other assets outside their IRA. Because that would be my other question. If somebody was asking me about taking money out from their IRA, is do you have other money? Because the IRA isn't a great place to go, especially before 59 and a half. And it is taxable, the whole thing. If you have other money someplace else that you can get to, I would not put the IRA at the top of my list of places to go to get money. If it's all I have after I look at everything else, then that might be it. But I would be, really trying not to go after that too badly.
So you talked about how it's taxable. Could you kind of explain that a little bit more in detail? Like, is it just like long-term capital gains, or is it kind of just ordinary income tax, or like how does it work?
Yeah, so one of the problems with an IRA is one of the more taxable accounts that you have in terms of taking money out. So what happened was when you put money into that IRA, or maybe it was a 401k or a 403b or any of these, they're all the same in this regards. If you're using the traditional version and not the Roth version, you got a write-off. So you got to avoid ordinary income when you put money in, and then it grows without any tax until you take money out. And so because you're avoiding ordinary income at the beginning, you now have to pay ordinary income tax, um, which can be higher than long-term capital gains. You can actually have long-term capital gains down to 0% tax if you're at a low enough, income level. But the max is 20%, and the max on ordinary income is 37%. So it is one of the things we deal with on a tax planning basis all the time is the taxable nature of the IRA, 401k, 403b, whatever it is, and really how to maximize your overall spending ability out of those accounts over the long term. It's a really big deal actually, especially because it looks like tax rates might be going up on ordinary income. So we'll see how that plays out.
Here's a question for Eason from Mia. It says, how do I pay for my child's college education? My daughter is starting next year.
Congratulations. College is a fun experience. Most people have some saved, but because of how quickly college expenses go up, there's a lot of shortfalls. And so one thing is how much can you pay from your current income? And then what are the other options that you can supplement? So usually each college has their own financial aid office and they know everything that their college can help you with. And usually they'll start with a FAFSA form, which is like a government form that kind of just figures out what needs you need. Um, and so with that, you'll start and it'll open up private and public loans to you. And there's also scholarships, which, there's a lot of different scholarships out there. So you can explore ones that fit for your needs, but those also will affect your need-based aid. And so if you're going for public or private loans, public is usually best if it's in your child's name, while private loans, I would recommend if it was for parents, because the public loans for parents usually have not as competitive interest rates, and usually they're given out because the credit check is a lot more lenient. So public rates for student loans though are quite low, and so but the rates differ every year, and so you have to fill out a FAFSA every year. So I'd look into what loans are available to you, whether scholarships or aid from the school is available to you, and those are some good options to supplement to pay for college.
So I have a follow up actually because I have two kids in college right now. One who's going to be in it for one more year, and then my daughter who's going to be for 3 more years. And it's kind of amazing how many little expenses there are that we don't all think about in terms of their housing, especially when they get off campus and those types of things. But one of the problems that I see is just if you're making decent money, it's very difficult to find avenues for funding college. I will say one thing about making decent money is that you can fund some of it out of your current cash flow easier. But what are the options for somebody who doesn't qualify for so many of these other areas just because of a higher income?
So for your child, there's always the option of unsubsidized loans, and that's not required any kind of like financial means. So it's like available to anybody as long as you apply for FAFSA. That
So,
usually can get you $5,000 to $6,000 per year,
oh wow,
um, based on the what year of college they're in. And then you have private loans. Private loans usually are in the range of 3 to 4%, but they can go up depending on your credit worthiness or not worthiness.
got it.
So loans are usually your best bet. Otherwise, you can maybe try and pull some money from other places, but I would recommend against that.
Okay. Thank you. That's good to know, actually. Yeah, because that's one of the things I kept running into was just, cutoffs because of income level, things that were available, which I'm fine with. I get that whole process, but it's nice to know that there are a few other options in case we need them at some point in time.
Thank you, Eason. So we have another question in here from Lorraine asking, are there any particular age milestones I should be thinking about, like age 50, 60, etc., when planning my retirement?
Huh. Well, in terms of planning a retirement, one blanket question would, suggestion would just be, as soon as possible. That's that no matter what age you are, having a good, solid financial plan for your retirement. It isn't as hard as you think, actually. Eason helps me with those, some emails going back and forth. We get the plan together, and then, every 6 months we just take a look at that. And so that's that's a generic concept of starting that as soon as possible because that will definitely help you reach some of your retirement goals. In terms of like benchmark ages, ironically, most of the people save a vast majority of their retirement assets starting in their 50s. You'd think maybe, we should all be starting sooner, but it is difficult to start sooner. We don't have a job originally, and then we finally get a job and we got all these things, trying to get an apartment, and then we get married, we have kids, get a house. And so I think a lot of the reason that 50s and beyond is the one of the big, benchmarks for saving for retirement is because that's when, things kind of settle down. The kids are out of college or what have you, and you got some extra money to save towards retirement. But age 62 is when you can first take Social Security. Age 65 is when Medicare starts. So that's actually a really big age to understand because if you retire before 65, you're going to have to cover your own insurance, what we call private insurance or COBRA or whatever it is, can be quite expensive. So it's something if you retire at 60, you're going to have to cover your own insurance for 5 years, and then you'll get qualified for Medicare and the supplements. And it's a lot less expensive than the private insurance. And then, of course, age 70 is the last age that you can take Social Security. So, you don't want to go past age 70 with your Social Security if you're waiting. So that's another, kind of benchmark age as far as that goes. But yeah, those are good things to kind of understand what you're looking at. A lot of people feel like they're way, way behind. I hear that all the time. I meet with a 30-year-old who has 150,000 saved for retirement, and they feel like they're very far behind. But statistically, across the nation, they're not. So it's never too late to start, that's for sure.
So going off of that, what about age 72? Is there any kind of a special thing with that?
Yeah, that's when you start to have to take money out of your IRAs, your 401ks, your 403bs, all of these retirement plans. They've allowed you to defer taxes on all of those plans and defer taxes on any growth you've made in those plans. And what they're doing is they're putting you on a schedule at age 72 to start taking money out of those plans. That becomes taxable income, again, ordinary income to you, not capital gains. And it continues to be a higher and higher percentage that you have to withdraw the older you get. And so that is a big piece of tax planning and retirement planning that we deal with is that required minimum distribution that starts at age 72.
So here's another question for Eason. My father just died and I'm inheriting his IRA. Can I just roll that over into my IRA? How will that work?
So unfortunately, the answer is no. When you do an IRA from your parents, they become a Benny or a beneficial IRA, and essentially you have 10 years to liquidate those accounts. The only time you can roll it over is if, say, you have a sibling and they unfortunately pass away. You have the option of then rolling over their IRA into your IRA if you're within 10 years, or if your spouse passes, then you can roll it over. Um, but if it's a parent, unfortunately, there's no rollover for that.
Yeah, this is actually one of the newest or newer areas of the tax law is this whole concept of inheriting a retirement plan, IRA, 401k, any of those things. Your beneficiaries now, again, if they're not within 10 years as a sibling or your spouse, they have to take that money out over a 10-year period. And there is no requirement right now for what they do. You can wait until the very end, let it grow, and take it all out at the end, or you can take it out evenly every year. So that's part of the strategy from a tax standpoint that we have to take a look at now is, what process. So there it really makes a big difference as to how big the IRA is. As you've got a big IRA and have it all come out at the last year could be a disaster tax wise. So if it's very small, maybe it doesn't really matter. And then it also how the beneficiary, whoever that is, what's their tax situation like? Is there a year where things are kind of low, where you might maybe pull out more that year than average, just to kind of get this IRA dissipated? Again, the government is looking to get their tax dollars out of that account over that 10-year period. So this is a new area of planning that we're now, wrapping our arms around also.
We have another question in from D asking, what are catch-up contributions? Do you have advice for those who are in a position to catch up?
Yeah. So if you're over age 50 and you're looking at a Roth IRA or a regular IRA or a 401k, a 403b, a 457, all of these plans, um, they allow a catch-up provision. So the IRAs, you can put an extra $1,000. So instead of 6,000, you could put in 7,000 if you're over 50 years old. On a 401k, 403b, those types of things, they allow an additional $6,500 that you can put in as far as that goes. So obviously, if you're saving for retirement, and again, just as I mentioned, people over age 50 tend to save more for retirement than any other time frame. Uh, and if you have the money, yeah, definitely, it's a great idea to continue to put in as much as you can as far as that goes. There is the HSA, the health savings account, which also, is something you can build up. It grows tax free. If you don't use it all, you can actually use it for some of your medical expenses in your retirement. That you have to be 55 or higher in order to add the extra thousand there. But anytime you have a chance to do catch up provision and you have the money, I would do it.
So going off of that, what are the catch ups? Where I know that each of these accounts have like a different limit, and there's a lot of confusion. Um, so what are the limits, and what's the penalty if I kind of go a little bit too high?
Oh, yeah. The penalties I'm not as familiar with. I know for the Roth IRA, if you put too much money in or you don't qualify because your income's too high, they charge you 6% per year. I'm not familiar with all the other penalties, but that's enough of a penalty to make people not want to do it, right? I mean, if you were paying a 6% penalty, you'd have to be making some pretty good money to make that work. So, um, yeah, it's $1,000 extra per year for IRAs and Roth IRAs, and $6,500 extra per year for 401ks, 403bs, 457s. Basically, what you'd probably call a company or retirement plan like those. So those are pretty good amounts. It'll add up pretty quick if you can do them.
Thank you. So why are interest rates rising right now?
Oh, well, that's a good question. Really, we're seeing, and matter of fact, if you go back to that, let me share that again because that's a good question. Here we go. Here's the leading economic indicators. Look, oops, sorry. Look at what has happened historically, right? So we have a downturn, and then look at how long it takes to get back, right? A fair amount of time. That's years. Here's 2000, about 5 years to get down. Here's 2008. Took, a long time from peak to peak here was about, what, 8 years. And so normally when you have a big downturn like you see here, it takes quite a while to come back, right? Because things are in pain here. There's a lot of unemployed, there's a lot of inefficiencies that have been just hammered out of the economy, and they're slowly recovering. Well, look at this. Look at the recovery time. So this hasn't happened. You don't see that anywhere on this chart going back to the 1960s. And so I think this is a great representation. Look at how fast we got back to where we were. So the reason was it wasn't an economic event, it was a health event. It caused an economic event. But if you throw enough money at it, like they did here, all these central banks, apparently we can get this economy coming back quite quickly. And so really that's what this is. This is this is not a recovery like we normally see. Even that can be somewhat inflationary, but it's usually not as much pressure because it's recovering kind of slowly. Here we're recovering, so fast. And basically what's happening, there's more people that want to spend money right now. I think the Americans saved $6 trillion last year in total. So there's more people that want to save money, spend money right now than these companies are able to even handle. Whether you want a rental car, or you want to go to a restaurant, or they just can't reopen fast enough. They have trouble hiring people. They're having trouble getting supplies like lumber and semiconductors and whatever it is. And there's more demand. And again, it's just because it went from 0 to 60 so fast and it came back, and we've never had anything like this. So what happens is if I'm making cars and somebody is giving me semiconductors, and all of a sudden they're short on them, man, and I'm making money making cars, and I got thousands of orders coming in, I might pay more for that semiconductor just to try to get it instead of my competitors buying it. And so there becomes kind of this feeding frenzy. That happened with lumber. It went up 4 times the value in a very short period of time because, again, there's housing starts are going nuts and people are building homes left and right. So that creates a situation where prices are going up. The employees won't come back out of their home for a variety of reasons, so they're having to pay more to attract people to come back to work. And that's all inflationary because all of those costs go into the product you're buying. Like right now, I think increased lumber costs have averaged $36,000 more per house, just for the lumber and the increase in the price. So that means that you're going to see interest rates on bonds come up. They come up with price pressure. And so that's what's happening. And we're seeing kind of this inflationary pressure that's coming from all of these supply side shortages. And it's really, really unique. This is a really unusual time frame. We haven't seen anything like this. Again, that chart I showed you, go back to 1960. There's nothing like this where that economy is coming back that fast after being down. So this isn't something we're used to. The corporations aren't used to this. They don't know how to deal with this. Uh, and if you look at it, why would you have all these planes or cars sitting there that nobody was using? And you're going to lay people off, you're going to sell all those rental cars or what have you, and so you're waiting for the demand. Well, demand has come. Now they're all scrambling around trying to get the pilots to come back. I guess the rental car companies are actually buying used cars on the used car market because they can't get enough new cars either. So it's a feeding frenzy. It's really interesting right now. So that's what's causing a lot of this interest rate increases. Now I feel a lot of this is temporary. So we'll see what happens there. Then that's more of an important argument as to whether this is permanent or temporary.
So how do I protect my fix or my bonds and my bond investment? Should I be looking to change how my duration or something like that to protect myself?
Yeah, because the one part that's going to get probably hit the hardest here and has been hit the hardest so far, uh, all the stock market indexes are up, at least a little bit, but the bond market is down for the year. As a matter of fact, the first quarter of this year was one of the worst quarters for the bond market, at least in price and total return standpoint over from the last 20 years. So the way that you protect yourself, from that is just essentially, and maybe I'll share my current portfolio for the bond side here real quickly too, because I do think this is an important area. There we go. Okay, so this is the bond portfolio that we're using right now as our, overall bond market piece. So to answer your question, yeah, short term. So I got short term governments, short term tips, and short term high yield. All of those are short term. Less than 5 years. Some of them are even shorter than that. There's not a lot of money to be made here, but in terms of a bad down market, these will do better as far as that goes. Probably my favorite piece out of all of this, and you can kind of see that because we have a little bit more weighted here, is the short-term tip. So a tip is a Treasury inflation protection security. So again, this is designed for this environment. These actually pay slightly higher kind of interest rates as the interest rates go up, which tends to protect the price from falling because there's an inverse relationship. When interest rates go up on bonds, price goes down. And so these tend to not go down as much, if at all. And these are doing quite well. The combination of being short term and a tip seems to help. And then I have two pieces here that go in the opposite direction. So these are both inverse or short positions. They go up when the bond market goes down. And so these are my protection pieces because I feel like inflation is just starting. I think we're just starting to see the increase in bond yields, which will drive the price down, and that would help these. So that's my look at how to handle kind of the bond market side of the inflation problem that we're dealing with.
So Tom, this week in Bitcoin has been pretty crazy. Why did it plunge 31% and then surge to 33% just within hours?
Yeah. Well, okay. So one of the things to understand, obviously, about Bitcoin that's different than most of the other assets out there, is there isn't anything behind it. So when I look at Apple stock, it has some volatility, but nothing like that, right? I've never seen Apple drop 31% in an hour and then come back a big chunk of that, all these big bounces. And one of the reasons is because, people aren't really willing to give up their Apple on a whim or just, something that happens because they believe that Apple's going to have a bright future, right? I mean, if you're owning the stock, you're hoping that they come out with better iPhones and better iPads and better iMacs and whatever it is, and they continue to, grow. When you look at cryptocurrency, the only thing you have is that you're hoping somebody else buys it for more than you, period. And the only way cryptocurrency works, I mean, is the fact that there is still lots of potential people that could come in and buy, right? It's a craze, but not everybody's in yet, right? And it's a worldwide craze. And so if I have Bitcoin, at a certain dollar amount, I'm just hoping somebody else comes in later and buys it. But once it starts to fall, right, I have nothing to look at. I can't say, well, I want to keep it because I think Apple's going to do okay. I look at Bitcoin, say, okay, I'm going to keep it. Well, why? I mean, I believe that it's going to be worth more in the future because more people are going to come in and buy. Okay, so that's why it didn't go to zero. Some people held on to it, but it creates a lot more volatility because there's nothing behind it. And then, people sweep in and start purchasing, and that's why it jumps back up. But it'll always be volatile, in my opinion, because it doesn't have that underpinning until it has something. The idea behind cryptocurrencies that's being touted is that it could be a world digital currency. And so that, theoretically, if it ever got to a position where that was something that was there, maybe that's enough and there's enough people in it and enough institutions to kind of create some stability. But that's not there right now. And actually, that big drop was precipitated by China cracking down on Bitcoin and cryptocurrencies. And the thought process is that they're trying to, promote their own cryptocurrency that they would be backing. And then just yesterday, the Federal Reserve Chairman talked about the possibility that the U.S. was going to look into what they're calling the digital dollar here this summer. So maybe the U.S. is going to be issuing their own cryptocurrency, which again, if you have Bitcoin or something else, that's a huge competitive thing that's going to happen there. So Australia is talking about their own cryptocurrency. So it's the Wild West, and that creates volatility. And you're going to see those types of things happen all the time. And it's one of the reasons that I can't get involved in that from a professional standpoint because it's too volatile for the portfolios that I'm managing. But it is pretty fascinating to see what's happening and see what type of relationship those volatile days are to our actual stock market itself too. So very, very interesting time frame.
I like that, the wild, wild west of cryptocurrencies.
Yeah, that's for sure.
Well, we do have just 2 minutes left, so I will ask just one more question.
Okay.
This one's in from Mike, and it is, are oil and energy stocks a good idea now that transportation will be on the rise?
Yeah, oil is theoretically going to be in more demand because people are going to be moving more, and that with the economy growing, things are going to be moving more. They're going to be shipping more things. So you got railroads, you got trucking companies, you've got UPS and and airplanes, and all these things. So when they really start rolling again, especially globally, which because we're as the U.S. is way ahead, so but globally everything starts moving, you're going to see a higher demand for oil, and we're seeing price increases. I mean, it actually was negative at one point last year, and it's at around 60 some dollars a barrel right now. The only problem with oil that you'll see just from a pure investment standpoint is it's fairly easy for more supply to come on. Saudi Arabia just has to decide to pump more oil, and then you could have the price kind of come down. And so it's a little bit of a weird market from an investment standpoint from that regards. Iran is now in talks apparently over this nuclear agreement. And if they can get to, a spot of happiness there, they might be allowed to start to reissue some of their oil onto the world market. And that happened last week, and we saw the price come down. So there is this big supply potential that's coming in. And so it's not as a clean of a play as far as that goes. But I do think here, at least in the short term, we're seeing some pretty decent runs out of some of these oil type companies because there is an expectation that we're going to see increased demand as the economy reopens. All right, good. Well, that was spectacular. Those are really great questions. I want to thank everybody so much for coming again and joining us. Really enjoy, going through this process. And again, if you're interested in capturing some of these videos and some of the pieces that we're going to carve up out of here, just go ahead and hit the subscribe button and then at the little bell if you want to get the email also. And that way you can get some of these videos as we post them, on our channel here. So look forward to seeing everybody next week, and thank you very much.